Good morning, folks. Just getting everything set up here as we prepare for this episode of Back to the Futures with me, Markets and Mayhem. Hope everyone's having a great trading week so far. I think it's going to be a pretty interesting session. I've got a lot of material to go over to talk about what's going on in these markets, whether it's the stock market, the metals, and Bitcoin. We're also going to talk about some of the top-down stuff, or the big picture, macro as we like to call it, because it is having a greater and greater role on what's going on in the broader markets out there. So I'm just making sure everyone can see the stream on all the channels we're going live on, and then we're going to get right into this presentation. And first thing I always like to talk about is risk management. I think that's the most important part of trading. It's one of the most underappreciated parts of trading. A lot of the folks that talk about fast riches, lottos, and Lambos, they leave out the most important part, that really this is a journey of building wealth over time. It's very rarely going to be one where you're just making enormous amounts of money in short time horizons and holding on to that. Often is the case, folks actually do themselves a bit of a disservice by getting really lucky early on, because then it feels like it's easier than it is. One believes they have the Midas touch, everything they buy turns to gold, and then they start to realize that actually they just got lucky and they start getting run over on their trades. They don't have the risk management and their account starts to get drained. So instead of taking that path, I highly recommend managing risk first and foremost and letting the rewards accrue over time. Because you don't want to learn about the fourth shape. What's the fourth shape? It's portfolio gone. Obviously, it's not a real shape, but for folks that go all in with leverage and don't manage risk and feel like this is the big one, I'm just going to put it all on black, that is the outcome that more than often is going to happen. I don't want to see that happen to any of you. I don't want to see that happen to anyone, quite frankly. I'd prefer that folks are able to make a good, good consistent kind of hobby out of trading, and then if they're really good at it, maybe turn it into something more than that. But to quit your day job, or to, drain your bank account, or worse yet, to go into debt to start gambling in the markets, please don't do those things. Build your own capital, start small, maybe even start with paper trading. Try to build a system, become consistent, and lean into that, journaling your trades and learning from your mistakes, as well as learning from your strengths. And the math, well, it doesn't lie. If you're messing around with risk management and you're taking big losers, you're going to have a much harder time climbing out of that hole. I mean, if you lose 10%, that's 11% to gain back to break even, right? So that's pretty much about the most you're going to want to lose on a position or a whole portfolio, because at least at that point, you're able to claw your way back over time. My theory is really 1 to 2% max drawdown of the total portfolio for any position. So one position should not give you more than a 1 or 2% loss. It's really important to think about it that way, because that means you're not getting so concentrated in these trades that they could blow up your account. You can see what happens if you do get more concentrated. If you lose 50% of your portfolio on a trade, you need to double to get back to even. The math becomes progressively less forgiving as losses compound. So this is one big, easy chart to look at to say, boy, why should I manage my risk? Why should I care about that? That really sounds like work. I'll tell you, it's a lot more work to build back your account if you don't. A bit about me, I've been trading for 21 years. I love the markets. This is really the most fun that I have. I mean, I wake up every day getting to do something I love. I feel very fortunate about that. I feel very fortunate that I've had some great mentors along the way, and I want to pay that forward, try to help other people become better at trading, better at investing. So that's really what I do. I've started companies that are all about that. So Trader Aid is all about helping our members build their edge, learn how to become more consistent, take a more systematic approach. And that's been a good thing in the sense that I've had a lot of success stories. I've had folks that have turned their trading journeys around, that have improved over time. That's exactly what I love to hear. And for folks that want more attention, I've got one-on-one coaching to help kind of guide the path and get back on the right course. But for my own journey, what really sparked an interest in markets for me was seeing just how much there was the opportunity to be able to gain an edge by learning more about how the markets operate, learning more about momentum and technicals, learning more about options and order flow, because you can start to build your edge. There's asymmetry that can be exploited with the data that a lot of traders don't necessarily lean into, and that's what builds my systematic approach. It's a data-driven approach. I backtest and create signals, particularly for swing trades. That's helped me to become more consistent, to take emotion out of the trade, but also to be able to really have an understanding as to why things are working. Because every week I'm reviewing my trading journal. What worked? What didn't work? How can I improve on these trades? What are the strengths that I'm seeing right now, both in the trades I'm making and the market around me? And what are some of the things that aren't working out? I like to say we all pay a tuition to the market. It's up to us to learn the lessons being taught. And that's why it really comes down to, if you create a trading strategy, that's great. But you have to be disciplined about executing it. You don't want to be the guy in the second picture where you have this great trading strategy, you've put all this work into it, and then the market opens and all that goes out the window and we just go back to gut feel. I know folks do that. There's nothing wrong with that. It's just you really want to lean away from emotion. You want to lean away from gut feel. And also, you want to lean away from the biases that you're holding going into the market. Like maybe you're going into the market super bulled up or super beared up. If you're day trading, those biases really, they're going to be harmful. You have to come in with a blank slate, because often is the case that on shorter time frames and even on longer time frames, what you think the market should do doesn't really matter versus what the market is ultimately going to do. We have to follow the data. We have to follow the momentum. So with all that being said, let's talk a little bit about what's going on in the markets. I think we're in a very interesting place right now. And good morning, Jason. Good morning, Loki. So we're seeing something that is rather unusual. Haven't seen it for about 30 years now. And that is international stocks are outperforming U.S. stocks by the most that we've seen since 1995 as we start this year, which is pretty incredible stuff. I think that this trend is set to continue. It happened last year as well. It wasn't quite at this much of an outperformance gap, and that gap started to build as the year went on because of trade tensions and otherwise. But I think this is a trend that's set to continue. You can actually see emerging markets breaking out of multi-decade ranges to the upside as well. I think there's still a lot more upside to come and emerging markets. I think that's an area where if you're very US focused, you might want to start looking out around to some of the other parts of the world, because from what I can see, valuations are more attractive. There are some pretty solid growth prospects, and it's also a decent hedge if you're concerned about the dollar over the long term. Back here in the US, something that concerns me a little bit is one of the bigger support mechanisms for the market has been buybacks. Buybacks are incredibly important to keeping stocks moving higher. Not only do they make the earnings multiples look better because you're taking the float down, so you're making the PE look better, you're making earnings per share look better. So it's kind of a bit of financial engineering. In fact, for a while, buybacks were actually illegal. But on the other side of it, what are they being substituted with? It's CapEx for AI. And this is becoming a greater concern for this market. It's looking at this and saying, gee, is this sustainable? Where's the ROI for all of this money spent? And it's a fair question. It's a question that the market is having to reconsider as we see yet another quarter of earnings from the mega cap techs with upsized CapEx, both spending during that quarter and moving forward. And we can't be terribly surprised. We have a tax system right now with the so-called Big Beautiful Bill that incentivizes a lot of this spending because you can realize a full deduction the same year. So companies are basically being told by the government, hey, if you're going to spend on this, spend what you can because you can realize those tax benefits near term. So that's on the one hand. On the other hand, however, AI is changing. It's becoming much more efficient, whether you look at the hardware layer, how we're doing inference, or the models themselves with an increasing density of intelligence. And that starts to suggest that you're not going to win purely by scale. You're actually going to have to do engineering to build higher quality models. If the race was just about scale, XAI and Meta would have won already. It's not just about scale. It's about density of intelligence per parameter, which makes some of these new open weight models pretty exciting, like GLM5, Minimax M2.5, and the latest model that just dropped from Alibaba's Qwen, version 3.5. These are models that are a fraction of the size of the US frontier proprietary peers and are punching above their weight. They're not necessarily the same as Opus 4.5 or 4.6 or GPT 5.3, but they're getting closer and closer. That gap is narrowing. And we're talking about smaller models too. So density of intelligence, that's the new benchmark. That's the most important thing to look at. And that starts to call some of this CapEx in question because that's more a race of scale, which hasn't really served a lot of the heavy investors well. Outside of Google, I don't think a lot of the mega caps doing this aggressive CapEx are necessarily on the right path. Just my own 2 cents. And here's why. Because free cash flow is becoming increasingly compressed. And that is going to become something that concerns investors more and more should this trend continue. Now, on the other side of it, really curious, both with the relative resilience of Apple. Apple, one of the biggest companies in the world, cannot be bothered to spend much on AI. Now, say what you will about Siri and their autocorrect. We know they're garbage, so they haven't invested in that either. But there's maybe a reason that Apple is skipping some of this investment. My own 2 cents, AI is a force multiplier, generative AI, but it's not yet at a point where it's going to replace humans at scale. We heard Microsoft's head of AI saying, AI is going to replace all white-collar jobs in 18 months. I personally don't buy that. I think we're on a further time horizon. We need to make the next step of progress in this research to get there. But nevertheless, this is one reason Apple's been relatively resilient. Now, let's get into some technicals and momentum here because these markets are starting to look pretty weak for the S&P and the Nasdaq. I don't like where the S&P is trading here too much. We really need to bounce very soon to get out of the way of breaking down from the bottom of this trading range. And we've had plenty of bounces back up to the top and then moves back down to the bottom. This has been a range that we've been trading basically for the last 2.5 months. Eventually, it is going to resolve. The longer it coils up, the bigger the ultimate resolution is for the directional move. That is to say, it's sort of like a spring. It's coiling up over time. and eventually that energy gets released. I'm starting to think that energy could be released to the downside here. If we do break the bottom of this range, particularly on a weekly closing basis, around 65.23 comes into play. That would be revisiting, or I should say 65.25 if we want to hit it right on the dot. That's the November low in this March contract. So that would be a level that if we do go back down and we see a nice retest and it validates that support, I'd be a buyer of swing longs right down there. I think at that point you've probably reset some of the excess long side speculation, and you have an opportunity to try to take a pretty good trade on a risk to reward basis. That is to say, you'll know you're wrong pretty quickly. So you could risk, say, 20 points for the potential to make 200 points. Those risk to reward ratios look pretty good to me. On the other side of it, Nasdaq also looking pretty weak here. It's a pretty similar chart as the S&P, but you could argue that this one has been in a trading range for really the better part of the last 4 months. And I think that the Nasdaq looks heavier than the S&P. It's never been able to reclaim that uptrend line from last year. I stopped putting it on the chart because it's almost at this point so far away it doesn't matter. So it's already kind of fragile in terms of the health of its momentum. And it's once again tempting the lower end of this range. Just like the S&P, I think if it closes below this trading range on a weekly basis, we're going back down to some prior lows. In the case of the Nasdaq, however, I think it would be revisiting the lows back from September, August. So that would take us down to about 23,000. It wouldn't be super surprising. It's not that far away. It's about a 5% decline. But that would also set up for an area where I would start considering nibbling on swing longs if we can get down to that level, bounce, show its support, and get some follow through. I'd start layering into swing longs, looking for a move back up of about 1,000 points. Then we have gold. Gold is actually looking pretty good. So we did have a mania in precious metals. There's no two ways about it. It didn't show up in commitment of traders because it wasn't professionals. It wasn't futures where this was being expressed. Largely, it's happening in the retail vehicles. So the GLD ETF, the SLV ETF especially, and their options. The mania that happened in gold was not anything even remotely approaching what we saw in silver. The sort of craziness that happened in silver was actually historic by nature. So for that reason and more, and we'll talk about silver on the next chart in a little more depth, but for gold, its uptrend is still intact. I'm still bullish of higher highs for gold, and it's sort of trading this channel. It's actually being pretty well behaved in this channel. We can see there was another reflection from the top of that range recently. I think gold could get to $6,000 an ounce by the latter half of this year. You know, sometime in the second half. I wouldn't be too surprised. It's healthy to see it consolidate these gains. It's healthy to see it move sideways. I know there are folks that are just looking for up, up, and away. In the commodity space, when you see up, up, and away, it tends to end badly. That is to say, these parabolic moves, they tend to end with downside that's even faster than that sharp upside move. So with gold, we've got an uptrend that still looks good. With silver, it's hard to make that same argument. Silver broke below its uptrend from December, that steep ascent that took us all the way above $120 an ounce. And now it's actually looking pretty darn weak. I don't think that basically, if silver can't hold above $70 an ounce, I don't think there's any way it's going to get. I kind of bungled that. I'm going to say it much more clearly. If silver can't hold above $70 an ounce, I think it's going back to 60. I don't think there's going to be much support. There's kind of an air pocket down there. And, you know, this big ascent that we had from December on did not build a lot of healthy market structure. The market structure that we have is right here at 70. Like, this is where the most chunky support exists. So if you're bullish on silver, you definitely want to see it hold here. But it is looking pretty heavy. Silver also tends to do poorly in February. The seasonality for the metal tends to be really rough. I think it only has upside about 20% of the time over the last 5 years. And this is something I posted in late January. I also shared with the Trader Aid members that actually during February, short silver and long gold might be the trade. And so far that seems to be working out relatively well. But I still do think over a longer time horizon, silver is going to get its momentum back to the upside, but it's going to take some time because we're doing that sort of cleansing process. We've shaken out a lot of the late longs. Now we're making silver boring enough that people don't really look at it quite as much. And then, you know, when that attention shifts away and you start to see some of these upside catalysts rebuild, I think we are going to get back to the highs we've seen and even higher than that. I wouldn't be terribly surprised to see silver around $150 an ounce by the end of this year. But I do think we have this sort of consolidation phase that needs to continue. And it's good if it does, because as I've talked about, when you consolidate, you're building that coiled spring. The longer you're moving sideways and chopping the range, the more robust the directional resolution will ultimately be. So if we can hold 70 and sort of chop sideways for maybe a month or two or three, when we ultimately resolve, and I think it will be to the upside, you're likely to have a very powerful move. So that's what I'm looking for with silver. More sideways consolidation unless we break 70, in which case 60 and even lower could happen pretty quickly. Bitcoin looks terrible. I can't say anything other than that, really, based on what I've seen with the charts on multiple time frames. I would not be terribly surprised to see Bitcoin down around 52,787. Right now, we're in a high volume node. We're kind of pinned to an area where there's been a lot of interest in transacting. The slip that we had was through a low volume node. So this big fast decline that happened, we just ripped through a low volume node. There wasn't a lot of defense. Now we're back in a high volume node that will probably hold for a little bit. You'll likely see some consolidation, and then I think we move lower. And really, the primary thesis here is very simple for me. Bitcoin is a relief valve for excess speculative liquidity. It trades like that. When there's abundance of liquidity, it's bid. When liquidity is scarce, it declines. Liquidity remains scarce. Bitcoin is declining and likely to continue declining. And so I think that's something we have to keep an eye on. Things like reverse repos, bank reserves, monetary fiscal policy, all of that can create some excess speculative liquidity needs to come back online for Bitcoin to get a more robust bid. So for now, I still think the path of least resistance is lower unless we can make a weekly break above that 72,255 level. Then there's our friend, the US dollar, which we hear all the time it's going to die, it's going to zero, no one wants to use the dollar anymore. I will say I take a much more middle of the road approach on this. On the one hand, de-dollarization is accelerating. There's no doubt about it. We've seen that trend accelerate since 2022 when the dollar was used as a weapon against Russia, Iran, and others. More central banks started to buy gold. More investors started diversifying away from U.S. assets. And that's only continued to intensify under Trump with all these trade tensions and all the sort of shaking up of the world order. On the other hand, however, this is a very formidable trend line. So to want to see the dollar break here, it could take some time. It may not break anytime soon. In fact, dollar short positioning across multiple metrics is very blown out. So the dollar hate trade has become the consensus trade. It's one reason metals had such a run, but also why they became crowded. And like when everyone gets on one side of a boat, it can kind of topple over. That's what happened in metals. We had the opposite happening in the dollar. Everyone's crowded on the short side. We might get a bid here. And so that's something you have to take into consideration if you're bullish of things that are denominated in dollars, like commodities, like Bitcoin, etc., that you may actually see a period of time where the dollar gets bid. These things see more pressure to consolidate or correct until this trend breaks. And this is a monthly chart. This is a trend that goes back to 2008. Something that has been in place for that long is going to take a lot more testing before it ultimately succumbs. So I think that's something we also have to keep an eye on. And remember, the dollar index is mostly euro, pound sterling, Japanese yen. These are countries with their own problems, their own policy issues. So, the fact that the dollar could get bid here as those other currencies skid is not that unlikely of a scenario. Looking at CTAs as a proxy for all this dollar hatred, and this is showing up in multiple charts. It's not just the CTAs. In fact, CTAs are a relatively small part of the foreign exchange market, but when you look at all of the different aggregates of data, it's a very crowded short trade in the dollar. And that's why I think we have to be a little cautious with precious metals and their miners, and a little bit cautious with some of the other things that are, basically on the opposite side of the dollar. For now, I don't think this is a long-term trend. I still think that all of the things that have eroded the dollar as a currency of choice for more and more trade settlement are going to continue, but it's a slow bleed. This is not something that's going to happen overnight. There's over $100 trillion worth of debt that's priced in dollars, for example, which creates recurrent demand for the dollar as it's being paid back. And there's still trades that are settled in the dollar, albeit less over time. That also creates recurrent demand for dollar and dollar denominated assets. So it's not going to happen with the snap of a finger. It's much more of a slow unwind over time. Now let's talk a little bit about these weekly pivots here. We're below it for the S&P, for the Nasdaq, for gold, and for silver. So all of these pivots are giving us a sense that right now it's a bit of a risk-off time. It's a good time to be more careful about how we're managing our positions, because this is a market that is becoming less and less forgiving, especially for the crowded parts of it. So I'm just putting this pivots chart out there on social media. You're welcome to take a screenshot of it while I do. And then we're going to talk a little bit about options, and then we're going to get into some live order flow analysis. All right, so let's talk a little bit about options as well. I've seen a lot of charts going out around the S&P and the broader index options showing some extremes in put buying. And while those charts are cool to look at, I find a lot more value in my own process looking at the CBOE equity put-call ratio. So instead of looking at index options where there's all kinds of hedging going on, I find the equity put-call ratio to be more helpful because it's really much more about sentiment. So right now, we're in the neutral zone. While the index option put-call ratio aggregates are showing extremes, where put-call ratio is over 1, this is showing us more in the neutral zone. So there's not that palpable fear in individual stock options. That tells us that we're not as close to a bottom driven by extremes as maybe some of the other charts might have suggested, which is good to calibrate our risk management. We should be looking for the potential further downside if we break below these trading ranges. And another way of looking at this is the variance between skew in the Nasdaq index and single stocks. Nasdaq index skew is back to highs we haven't seen since early 2025. So those are the more sophisticated hedging strategies coming online. Those are larger institutions trying to protect their book, or maybe even levering up a little bit into this weakness by using those puts to decrease their value at risk ratio. But on the other side, single stock skew pretty low. Not a lot of nervousness in the single stocks yet, despite the fact that software as a service has had its worst 6-month rolling returns ever, worse than the dot-com bust. Still not a lot of nervousness out there. We'll see if that changes. Now with the S&P 500, we've got a pretty sizable put wall down here at 6,800. That's right down there at the lower end of that trading range as well. So you have confluence, the lower end of the trading range, and that put wall at 6,800 just around the same level. So that tells us we should see some support right around here. But if we do break, we can have an accelerated journey to the downside. So again, looking at this trading range in the S&P and the Nasdaq and really looking for that bottom to hold if you want a bullish resolution. But these are looking heavier and heavier. It is becoming more likely that we could have some continuation of downside. We're also in negative gamma territory, which typically feeds on itself. That is an environment where dealer hedging patterns change a bit. So you see dealers more likely to sell dips and buy rips, which is a volatility catalyst, essentially. And here are our S&P options levels. These are for the index, so you're welcome to take a screenshot of these. This is from the SPX options visualizer. And I'm just putting that out there on social as well. You're welcome to take a screenshot if you'd like. These are levels that we make available to our Discord members. You can get them automatically from our bot, updated throughout the trading week. And one thing about this, I know that folks are getting a little nervous. You know, there's a pretty nasty market out there overall. You know, outside of some of the sectors that have done really well, energy, for example, some of the defensive stocks, there is some pain, especially seeing that happen in the more crowded parts of the market, growth in tech and precious metals. So I get it. But this is simply a phase. You've got to make a shopping list. You've got to have dry powder and be ready for when the selling is over to take advantage of some of these discounts. And speaking of discounts, you can get up to 40% off Bookmap by visiting traderaid.com/bookmap. You can also get 20% off TraderAid plans using the code Mayhem20 at checkout at traderaid.com. So with all that being said, we are going to get right into Bookmap here. We can see the markets are open. We're getting a pretty nice little pop off the opening bell. Good morning, Devin. Good morning, Timsa. Good morning, Paul, Denny. And just as quickly as that pop happened, we're starting to see a bit of a reversal. But buying pressure here, this is pretty aggressive overall. So I wouldn't be surprised to see an attempt to continue making this push. We are at the bottom of this trading range. We are at a level right near this S&P put wall. So, you know, we could see it right here on the chart. It wouldn't be too surprising to see buyers try to defend that level. We also have some constructive geopolitical news coming in over the wires from Iran. Iran saying we've reached an understanding on the main principles of these negotiations with the United States, and we're seeing that have a negative effect on oil prices, which is to be expected here. And I've got a question from Loki. Please tell me why it is that silver and gold are moving together like this. It's bending my brain a bit. I think that, for one, you've got the entire country of China on holiday. Asia has traditionally been a marginal bidder for precious metals. So you put that marginal bid on vacation for a bit. That's certainly not going to be helpful. So I think that's a big part of it. And typically during the Chinese Lunar New Year, you do see some more pressure in precious metals. So I think that's the big part of it that you know, is having an effect. And the other side of it is this is still very much a tug of war. So you do still have folks that are determined, that are bearish of these things, that are continuing to lean in. In fact, in China, last I checked, there was an incredibly concentrated silver short position by one of the traders there that got the gold long right as well. So there's just speculation on both sides of this trade. It's going to be a tug of war until it eventually resolves. I do think it resolves to the upside, but I think that this back and forth, this consolidation and correction is healthy. It's what you want to see. You don't want things just going straight up. When that happens, it tends to end poorly for everyone that's long. And so while we can see what's happening near term on the S&P, let's just zoom out a little bit. See if we can pull up some more of the historic price action here. And we're just going to backfill that data, so we'll give it a minute. But nice consolidation going into the opening bell, kind of that coiled spring, but on a micro time frame, and then breaking above that consolidation area with some vigor, some decent buyer aggression here. Seeing a little bit of iceberg selling from those highs, but not too much. And seem to be getting a little bit stuck pulling in that historic data for the S&P. So we're going to shift up. We're going to look at the Nasdaq now. Very powerful move off the opening bell in the Nasdaq as well. And looking at the heat map, you can see there's a decent bid for financials and some of the techs. Apple up 1.4%, for example. Qualcomm up 1.37%. ServiceNow, one of the software stocks, it's been absolutely decimated, up about 2%. And some of the banks, which some of whom are in the Nasdaq, but we're seeing financials get a decent bid as well here. And so Nasdaq bid up over 100 points off the opening bell. Let's also move to silver here. Silver, the struggle continues, which again is to be expected. I think it's going to be a choppy trading environment. I would prefer it doesn't break down below 70, but if it does, the market's going to do what it's got to do to kind of cleanse all of what's happened leading up to this point. And silver did go 100% parabolic, and then it crashed. And after you have a move like that with the sort of positions that get unrolled, you do typically have a market that is much more sort of consolidating and choppy until we find direction again. So I think that's going to be the case for silver. I think that's also to some extent going to be the case for gold, but gold structurally looks much better than silver, as we talked about pre-market. Good morning, American Constitutional Republic. And that's someone's name. I'm not saying hi to the whole country, but hi to the whole country too while we're at it. Let's do that too. It's fine. And this is still pretty good buyer aggression so far to start the day. Some of it, again, from the positive geopolitical developments. You know, no one wanted to see the U.S. and Iran get into a war. So if we're going to take that off the table, and I wouldn't think it would be like a full-scale troops on the ground type of war, but any kind of kinetic escalation. If we're going to take that off the table, that is constructive to risk assets near term, without a doubt. Now, looking at today's calendar, we have housing data coming out at 10 a.m., Barr speaking from the Fed at 12:45, Trump at an ambassador credentialing at 2 p.m., Fed's daily at 2:30, and then Trump participating in a policy meeting at 4 p.m. Eastern. So overall, relatively light day. Pre-market, we got New York Fed manufacturing, which came in marginally better than expected. And as a reminder, China is on holiday for their Lunar New Year. So that is one reason you're going to have less of a bid in precious metals. Let's zoom a little bit in on this price action here. Tim, so I use a combination of different analytical techniques. So I use options levels, I use pivots. Pivots are derived in part from volume profile, but also other parts of analyzing price action and momentum. And I really do like to look for convergence between different indicators showing me that a certain level is important. Now, one of the reasons I do focus a lot on options flow and levels is because they are the tail that wags the dog. You've got about 1.3 trillion of notional flowing through the S&P index options every day. And that's far more than all the index futures contracts combined. So really, when we're watching the price action in the futures, a lot of that influence is happening from options trading, where dealers are hedging deltas, where they're selling contracts. They have to hedge out that exposure by buying or selling futures to flatten that delta. So when you have this much options activity and about 60% settle same day, 80% within a week, you've got to really look at the flow and the levels, particularly for the closer dated options. So I do pay a lot of attention to that, but it's not the only area that I focus on. And also on this chart, you'll see I have the point of control. I've got VWAP. I'm looking at that as well as the liquidity heat map. And folks, if you have questions, if you're out there watching, you're always welcome to ask. And seeing a bit of a drop now. We had buyers pull up that point of control. We're starting to look a little more constructive just for sellers to start coming in and tape bombing. You can see that aggression picking up with the larger size delta bubbles here. Icebergs, interesting, are actually buying into this dip so far, like continuing. They've been scooping up even as we've been making highs, but are continuing to accumulate. Not a lot of accumulation, not enough to show indications on the chart, but you can see in the subchart just nibbling even into weakness here. So the question about horizontal lines, the question about liquidity on the chart on the Bookmap Discord, you're going to know there's absorption because you'll see it in the volume. And I think that's where you kind of want to look to see whether or not that order went through. Like right there was absorption of that bid. We'll zoom out just a little bit so that we can see this whole move from the open. Even just before the open, we started to make a powerful push higher. We got some good headlines out at about 8:50 a.m. talking about progress being made with the U.S.-Iran talks. That helped to drive down oil prices and probably lent a bit of a bid to the market at open, but we're seeing that now reversing. And sellers are increasingly aggressive here on this reversal. So on this downside move, I would be looking at the put wall area as a potential area of strong support. Let's take a look at the Nasdaq as well. Very similar move in the Nasdaq. Worth noting that when the Nasdaq was getting that heavy bid earlier, the only really big tech stock that was getting bid higher was Apple. Microsoft, Amazon, Tesla, Google, Meta, still not bid. So Nasdaq round tripping, S&P round tripping. So we saw that defense of the lower end of the trading range, but it doesn't seem to be a particularly strong defense as sellers step in. AFODEV, yeah, those are some of the indicators I use. It's a little bit more nuance involved in the process in the sense that I also am looking at multiple time frames. If you were tuned in to the earlier part of the session, you'd see some of the charts that I look at to determine trading ranges and things like that. So I'm looking at momentum and trend as well, but I'm zooming out to broader time frames to qualify that. And then for day trading, I do like to look at the 20-minute opening range, and I am building a opening range indicator for Bookmap that I'll be giving out for free once it's done and tested. That can help to kind of show that on the chart a little bit more clearly as well. Because I do think that looking at the opening range, you can start to see the potential for trend days when you see these break aboves and break belows with continuation, especially when the options flow agrees. So that can be a helpful confluence as well. And I think liquidity is important. Like, for example, look at these indicators top and bottom. What does that show you? These are the stacked offers. These are the stacked bids. They're in balance right now. So neither side, based on the order book distribution, has too much of an advantage based on that. That's another indicator that I do like to look at. That's the reason I added these onto my Bookmap chart as well. And I like to look at stops and icebergs for extremes. Like if you have a really large amount of stop outs happening to the downside, at the same time you have a sizable amount of iceberg buying happening into that weakness, often is the case that that's where a reversal can start forming. So that would be a place where I'd start taking off shorts if I had shorts on and looking for the opportunity to bid into that. There's those sorts of setups that can happen from extremes in flow, particularly flow like stops and icebergs as well. Seeing S&P now cracking to new session lows here. And remember, we're watching this area down here. We're starting to see some liquidity come out in the bid side around this put wall. And pretty much a full round trip. And we're starting to get some of that flow in from CBOE. So let's see if that posts momentarily here. Also going to shift over the Nasdaq, take a look at what's going on in that chart. Similar look, round trip, and now, wow, seeing some more aggression from sellers. Really starting to lean in. So as we break the bottom of that range, they're starting to get the sense that that 20-minute opening range is breaking to the downside with this push and leaning into that momentum for continuation. So Nasdaq getting a nasty break to the downside here. S&P following the Nasdaq down, also breaking below our put wall. Let's see if Bitcoin's rolling over. It is also rolling over. So sort of all the risk heuristics we have here are all rolling over at the same time. Not the best thing to see. Certainly opens us up for a continuation of this downside. Let's also take a look at gold and silver, also rolling over here. Silver getting closer and closer to that key level 70. We zoom out. There's actually not a lot of people on the bid at 70 either. It's 71 and 72 where most of that interest is. And gold also has a pretty weak microstructure here overall. Going back to the S&P, just sort of stair-stepping lower. And seeing that selling pressure continue to escalate here. Now, one of the things I've been talking about that I think is very much related to why we're selling is that the AI CapEx narrative is starting to see a bit more skepticism. And that's not a bad thing. I mean, the idea that we need unlimited compute and incredible amounts of scale when density of intelligence per parameter is becoming the more important benchmark, it doesn't make as much sense. It really doesn't. And I think that's something that's going to change the conversation about generative AI spending as the year goes on. It's the question in investors' mind is, where is the ROI for all of this CapEx? Which is probably a reason that Apple is bid as the rest of tech is skidding here. The upstream beneficiaries like Nvidia, Micron, AMD, Broadcom, they're all down. But so are the sort of Mag 7 hyperscalers like Microsoft, Amazon, Google, and Meta. So it's really Apple who hasn't put money into AI that is enjoying a bid in this tape, which is not a coincidence. We talked about that a little pre-market as well. And we are breaking below that put wall now, which is not a great look. And folks, we'll be wrapping up in 5 minutes. If you have any questions for me before we do, please let me know. We've got data coming up at 10 a.m. as well. U.S. NAHB Housing Market Index. Expectation of 38, prior read of 37. This is not going to be a big market mover, but it's still worth watching, especially if you're looking at things like home builders, which have been surprisingly resilient. We're going to zoom out just a little bit to see where the flows are. So we're moving well below the options implied low here on the market. That's interesting. We'll see if that flow shifts up. And we're starting to see a fair amount of liquidity building just below price here. One of the things I like to watch with that is how we react. It's all about auction theory. If we reject that liquidity, that's telling you sellers do not have the supply to take out those bids. If we cut right through it, then that gives you a sense we'll probably have more continuation lower because they're not deterred by seeing bids coming up right below where price is trading. So you can apply auction theory to these intraday liquidity events as well, and I think it can be quite helpful. And so far, we're not seeing sellers make an aggressive push below these areas of bids. But buyers are also not showing us much conviction. So still looking a little bit heavy. We're going to see whether we react there. But as data is getting very close, we're probably going to see liquidity tighten up a little bit. We tend to see these automated market making algorithms kind of pull away before an event. But I will say this much, I do not like seeing S&P breaking below the bottom of that range. I think if we are going to close out the day like this, and especially the week, it's going to start to look quite a bit worse for the potential that this thing rolls over back to the November lows. And we are seeing sellers now chewing through those bids. We're also seeing some more stop outs to the downside and some iceberg selling. So overall, sellers do seem to have the supply to keep pushing this lower. We're going to wrap it there, folks. I appreciate you tuning in. To learn more about my work, visit traderaid.com. To get up to 40% off Bookmap, visit traderaid.com/bookmap. And tune in next week for the next episode of Back to the Futures with me, Markets and Mayhem, Tuesday, 9 a.m. Eastern. See you then.